All right, so I'm going to walk you guys through homework problem number 5. Initially, I wanted you guys to just do this one on your own. I think homework should be more challenging for you because you have a lot more resources available to you when you're working on homework. You've got myself, you've got the GAs, you've got your book, you've got your notes, you've got all that good stuff that's available to you that you should be using when you're trying to complete homework. Also, your classmates. I told my first section the other day, hey, pick an accounting student in here and be friends with them because they get this already. Like this is already clicking for them. So it wouldn't hurt you to maybe ask around, see who's an accounting student. Maybe work on your homework together occasionally. I don't consider that cheating in this class. I think it's good for you guys to be working in teams, to be leaning on each other as a resource. You'll be doing that in your professional lives constantly anyways. So working on homework together, I don't consider cheating. Now, if you're just straight up copying it from somebody, that's a different story. But so, use all those resources when you're doing your homework. But I've seen that this problem's given people a lot of heartache, so I'm going to just go ahead and walk you guys through it. So the first thing we want to do is just read through the problem, find out what do they need us to do. So the first thing I always do is I just read the last line, okay? Record the journal entry for this transaction. Well, I can see that they've actually got 2 journal entries here. They've split them up for you to be kind. Technically, this would be one single journal entry when you make the sale. But they've split it into 2 pieces here. They've split it into the recognition of the sale or the revenue and the recognition of the expense in the second journal entry. So let's go ahead and read through this and decide what are some key terms that might tell us what accounts we need to use, right? So suppose that on January 1st, 2020, Boeing sells one of its 777 series planes to Singapore Airlines on account. Okay, so a couple key terms here. Sales. If we are in the business of sales, which it appears that we are, then if we sold something, we have met our end of the bargain and we can recognize that amount as revenue. So we've got a revenue account we need to hit. On account. This is the other one. They didn't give us cash. There's no cash involved in this transaction yet. They've just made a promise to pay us cash in the future. This is accounts receivable. Okay. Now it does tell us it's its first and only transaction on the first day of the fiscal year. This will become important in 2 and 3. You'll see in 3 we're asking for a new balance, and 2 we're not. There's a reason for that. Okay. The sales price is 400 million, so we know our revenue is going to be 400 million. We know our AR is going to be 400 million, and the inventory costs $330 million to manufacture. So we know that our cost of goods sold and expense is $330 million, and a piece of inventory that we are getting rid of to decrease, we're going to decrease our inventory account, which is an asset account, by $330 million. So we get all of that just by reading the problem and just by picking out some of those key terms, right? So journal entry 1, we're going to recognize the revenue portion of this. So easy enough, right? We've got accounts receivable, $400 million, right? How did we know that? How did we need to know we needed to debit that? Well, let's just remember our DEAD acronym here, right? We've got DEAD right here. Debits, increase, expenses, assets, and dividends. Accounts receivable is an asset for us. It lives right here, okay? So if we're trying to increase it, we need to debit it, and that is exactly what we did. Now, the second account here is going to be sales revenue. What did we do? Well, we recognized some revenue, right? We sold some goods. It's going to be $400 million as well, okay? Your debits must equal your credits. How did we know sales revenue was our credit? Well, does it exist? Does revenue exist in this DEAD acronym anywhere? No, it doesn't. So if it's not here, it increases with a credit, okay? So that's how we knew we were going to credit our sales revenue, okay? So now let's do the second part of this journal entry, and this is the expense, because when we sell something, when we generate revenue, there is an expense associated with that. What is that expense in this case? Well, cost of goods sold. It cost us something to sell that good. That's our cost of goods sold. How much? $330 million. Okay. How did we know that was our debit? Well, it's an expense, and expenses live right here. We're trying to increase an expense, right? So we're going to debit it. Why do we increase that expense? Well, because when we increase an expense, we decrease net income, which decreases retained earnings, which decreases equity, right? Be able to follow that logic all the way through your accounting equation. So what is our credit? We know we've got a debit. Now we need a credit. In this instance, we're lucky. There's only 2 lines that need to be used. So we know one of them's a debit, one of them's a credit. We've got our debit. What's our credit? Well, it's going to be inventory, right? So this was that asset that we have that we're decreasing. Okay. How do we know we need to credit inventory? Well, inventory is an asset. It lives right here, but we're decreasing it. So if we're going to decrease something that increases with a debit, we need to credit it. Okay. We just do the opposite. So we're going to credit that for $330 million. Okay. Now, note, there's another note here. It says enter debits before your credits. That's just the format. We talked about this in class. Debits first, credits second, right? And you'll notice debits are justified to the left all the way, and your credits are slightly indented. Okay, so let's move on to requirement number 2. What they're asking us here is which accounts on the income statement, and this is a big clue, right? What's on our income statement? Revenues and expenses, right? That's how we find income, is revenue minus expenses, so that's what goes on the income statement. So what revenue and expense accounts did we hit? Well, we hit sales revenue, pretty obvious, says revenue right in the title, and we hit cost of goods sold. Those were our revenue and expense accounts. So let's go cost of goods sold, going to increase by $330 million. That was our expense that was increasing, okay? And then sales revenue is going to increase by $400 million. It's not typing in, but just know that's $400 million, okay? All right, so requirement number 3 is asking us the same thing, but from the balance sheet perspective. What accounts on the balance sheet were impacted, and do they increase or decrease as a result of this transaction? We've been doing this in class. With all 10 of those transactions that we looked at, we stopped and we asked ourselves, what accounts were impacted? Did they increase and decrease, and by how much, right? And then is our equation still in balance? And this is all this is asking us, right? This is just the second part of that question. Which ones increased or decreased? Journal entry was the first part. These next 2 requirements are that second question. Do they increase or decrease, right? Let me see if I can get this in here now. Yep, perfect. Okay, so that's $400 million in requirement 2. So requirement 3, asking about balance sheet accounts. What balance sheet accounts did we impact? Well, we impacted accounts receivable and asset, inventory and asset, and one more. What did we impact? Well, for this one, you've really got to think from the big picture perspective, right? So we really got to think from the big picture perspective here of assets equal liabilities plus equity, right? Equity is common stock and retained earnings. Retained earnings is net income and dividends. Net income is revenues and expenses. Well, what did we do? We increased an expense, we decreased net income, we decreased retained earnings. But by how much? Well, that $400 million was our revenue. That $330 million, right, was our expense. So we got $70 million in net income. Okay? So technically, sorry, this retained earnings portion, I need to change it up. We actually increased net income, by $70 million, and we've increased retained earnings by $70 million, right? Sorry about that. Got that a little backwards, but we've cleared that up now. So what's happened? Well, we increased accounts receivable. That's our first, by $400 million. We decreased inventory, right, by $330 million. I'll have to come back and type that in again there. It's not working, but that's $330 million. Then we got retained earnings. would increase by 70 million. So that's 70 million right there. Okay. I hate that that's not typing in. I don't know why. Okay, so now we need to actually go to sec.gov/Edgar. We need to find Boeing. This is the easiest way to do that. Boeing. 10Ks, view all 10Ks, and then we're looking for 12/31/2019 right here. Okay. And then we know by now, hopefully, that we want item 8, which is your financial statements, right? So here we've got consolidated statement of operations. That's your income statement. We've got comprehensive income, which we don't deal with in this class. And then we've got consolidated statement of financial position. This is your balance sheet. Why do they call it a statement of financial position? Well, because the balance sheet literally shows you your financial position as of a certain date and time, right? Note here that these are also in millions, okay? So what we need to do is we need to look at total assets, 133,625. Those are our total assets, okay? So let's remember that, 133,625, okay? So what have we done here? Well, we need to go back here and we're finding the new balance of assets on our balance sheet. So after we add in accounts receivable for 400 million, we have 134,025. Okay. Now let's reduce that by the 330 million for inventories. Okay, 133,695. That's your new asset balance. Okay. That is the new balance in your asset account, taking that transaction into consideration. Okay. So, requirement 4, they're going to ask us, what's our new asset balance, right? So we know our asset balance was 133,695. We're not sure what our liabilities are yet, and we're not sure what our stockholders' equity is yet, but we can solve for that. Okay. It's not too difficult to solve for these. So we know that assets equal liabilities plus equity. An easy way to do this, because here's what's going on here. We can look, we got total current liabilities, but that's not current total liabilities, that's just current. So we could add all these numbers right here up, right? From this line right here through here, we could add those together and that would be your total liabilities. Or you could rearrange your equation to say assets minus liabilities equal equity, right? So you can do either one you want. Neither one is terribly difficult. We could just add these together, and that's what I would recommend doing right now. Okay, so you just say 97,312 plus 413 plus 4540 plus 16,276 plus 3422 plus 19,962. 141,925, right? We've got 141,925. So what we've got right now is this top equation. So we know that 133, 695 equals 141 925 plus x, right? So how do we solve for this? Well, we subtract this from both sides, right? And what do we end up with? Well, 133, 695 minus 141, 920. Whoop, sorry. Negative 8230. Is your equity. Okay, so yes, it seems strange that your equity is negative right now, but that's okay. Remember, this is your first transaction this year. You know, it's the same reason we didn't put any new balances here, because these are our new balances, right? They started at 0, and we'll talk about this in chapter 4 as well. Those started at 0, so those are the new balances, whereas these roll over every period. So we have to calculate a new balance here. And then you can see by doing this that our equation still balances. This is the third question we always ask ourselves. So hopefully this helped you guys